All right, listen closely, because this is something every trader needs to understand before they start throwing their capital at every candle that moves on the chart. In the previous video on how to spot trends without any indicators, we talked about learning to see the market with your own eyes, not with borrowed opinions or flashing tools. You learned how to sense the market's rhythm, how to catch the direction of the tide, before the crowd even knows there's a wave. Today, we're going to build on that foundation and talk about something even more delicate, more dangerous, and far more profitable if you get it right. How to identify a trend reversal early. 3 ways to be exact. Not by magic, not by wishful thinking, but by reading the story the market itself is writing every single day. Now, I've seen more traders ruin themselves by ignoring reversals than by missing entries. You see, any fool can buy a rising stock and ride it for a while. That's easy. But when that stock starts to turn, when the music slows and the crowd doesn't notice it yet, that's when the professional steps in and the amateur gets buried. Do you know why? Because the amateur is still listening to hope. The professional is listening to the tape. When you're watching a stock move, the first sign of a trend reversal isn't always loud. It's quiet. A hesitation, a slight pause where there used to be steady conviction. I used to say the market speaks softly before it shouts. If you train yourself to catch that whisper, you can get out before the crowd even begins to wonder what went wrong. The first way to spot a reversal early is by reading price behavior itself. Forget the fancy indicators and blinking dashboards. Watch how price acts around key levels. When a strong uptrend begins to falter, you'll see the stock stop making those clean higher highs. Suddenly, a rally runs into resistance, and instead of breaking through, it hesitates. Sellers start showing up just a little earlier. The stock might close off its highs for a few days in a row. Do you see that kind of action and shrug it off? Or do you ask yourself, who's selling into strength here? Because someone always is. When I was trading in the bucket shops as a young man, I didn't have algorithms or economic data at my fingertips. What I had was a notebook in my eyes. I watched how stocks behaved around round numbers. 50, 100, 150, and I noticed something curious. Every time a trend was nearing exhaustion, the moves became smaller and reactions came quicker. The tape lost its smoothness. That's the market telling you, quietly, I'm tired. If you ignore that, you'll pay for it later. Now, the second way to catch a reversal is by watching volume behavior. Volume, my friend, is the truth serum of the market. Price can lie for a while, but volume never does. When you see a strong uptrend begin to rise on shrinking volume, it means enthusiasm is drying up. The buyers who once fought for every tick higher are now hesitant. They're not chasing anymore, and when you finally see a big down day on heavy volume, that's not just a random dippy. That's smart money unloading. Have you ever noticed that? A stock can look perfectly healthy until suddenly one day it falls 5%, heavy volume, and never quite recovers. That's distribution in action. Most traders make the mistake of thinking they can predict these moments by guessing. But this business isn't about guessing. It's about reading. You've got to train your eyes to see what the market is saying. In the previous lesson, we talked about seeing trends without indicators. Pure price observation. Now you're going to take that same skill and apply it to volume. You're not looking at numbers, you're looking at behavior. Think of it like this. When people are excited, they talk louder, right? When they lose interest, their voice fades. The market's voice is volume. It's either roaring or whispering, and if you can sense the change in tone, you'll know a reversal is coming before the headlines do. The third way, and this one takes experience, is psychological observation. You must learn to read the market's mood, just like a poker player reads the table. When a trend has gone too far, you'll feel the euphoria in the air. Everyone's talking about the same stock. The news is all optimism. It can't go down, they say. That's your first red flag. When the market starts to sound certain, I start to get cautious. I remember before the crash of 1907, people were saying the same thing. This market can't go down. They'd insist there's too much money to be made. And yet, the tape told me otherwise. The advances were getting sluggish. Big interests were unloading quietly. Then, one morning, the dam broke. The same traders who had been laughing were now pleading. You see, markets turn when confidence turns, and confidence turns before price does. So, let's tie these three together for a moment. You've got price hesitation, volume drying up, and sentiment boiling over. That's the trifecta of a reversal forming. You won't always get all three perfectly lined up, but when you start to sense two of them, you'd better start tightening your stops or taking some money off the table. Ask yourself right now, are you the kind of trader who waits for confirmation, or the kind who prepares before the crowd panics? Let me tell you something important. Reversals don't come out of nowhere. They build slowly. The market telegraphs its intentions if you're patient enough to listen. But most traders are too busy talking to themselves, convincing themselves that their position has to be right. They confuse conviction with stubbornness. And in this game, stubbornness is fatal. I've always said, the big money isn't made in the buying or the selling. It's made in the waiting. Waiting for the setup, waiting for confirmation, waiting for the right moment to act. But when the time comes, when the price starts to falter, volume confirms it, and sentiment turns hot, you must act without hesitation. Do you hesitate when you see smoke coming out of your house? Then why hesitate when your stock shows signs of reversal? You see, trading isn't just about charts and numbers. It's about temperament. If you want to catch reversals early, you need to cultivate detachment. The market owes you nothing. The moment you start thinking, it must go higher, you're done. The market doesn't care what you think. It's not about being right. It's about being aligned with the truth of the tape. And here's another thing. Wealth in trading doesn't come from a single brilliant call. It comes from avoiding big mistakes. Missing a reversal can wipe out weeks or months of good trades. So your first duty as a trader is to protect your capital, not to chase glory. Every dollar you keep in your account is a bullet you can fire tomorrow. The man who loses his ammunition too soon has no chance when the real battle starts. When I study a stock that's been trending for a long time, I start to look not for reasons to buy, but for signs of weakness. I ask myself who's left to buy, because once everyone's in, the only thing left to do is sell. The smart trader senses when the crowd has exhausted itself. He doesn't need to know the news. He can feel the market's fatigue. That's what separates the professionals from the amateurs. The professional watches, waits and reads. The amateur hopes. And hope in this business is poison. Have you ever caught yourself saying, "It'll bounce back"? That's not analysis. That's emotion. And emotion blinds you to what the market is showing you in plain sight. Remember how in that previous video, we talked about letting price be your teacher, not your feelings. This ties directly into that. The same skill you use to recognize a strong trend is the same one you'll use to sense when that trend is losing power. You're just reading the same story. Only now you're paying attention to when the plot starts to change. You'll notice that sometimes reversals begin with a violent move in the opposite direction, a sudden surge of panic or excitement. Other times it's slow, deceptive. That's the tricky part. A market can pretend to be strong right up until it's not. That's why you must learn to watch the character of the moves. Are rallies being sold into? Are dips being bought less aggressively? Are volume spikes coming on down days rather than up days? Those are your breadcrumbs. And don't think reversals happen only at tops. Downtrends reverse too, and the signs are similar, only flipped. A beaten down stock stops making new lows. The volume on sell-off starts to dry up. Buyers quietly step in, not with fanfare but with patience. The public still calls it dead money. But the professionals are already building their positions. Have you ever noticed how the bottom feels most hopeless right before the turn? That's not a coincidence. That's how the market fools the most people. Trading is a constant test of perception. You're trying to see what others don't, or what they refuse to see. That's where the money is. But seeing isn't enough. You must believe what you see, even when it contradicts your hope. Because hope doesn't make you rich. Discipline does. Now, These three methods, price behavior, volume confirmation, and sentiment reading, are simple on paper but hard in practice. They demand that you observe more and act less. The crowd does the opposite. The crowd acts first and thinks later. That's why the crowd loses. If you want to be on the winning side, you have to train yourself to think independently, to question everything the market shows you. Ask yourself, is this strength genuine, or is it exhaustion disguised as strength? When you can answer that question without guessing, you've arrived at a level of understanding that most traders never reach. And that understanding doesn't come from luck, it comes from hours, days, years of watching the tape, of losing money, of learning the hard lessons that no book can teach. Every loss is tuition, every mistake a professor. You know, there's a kind of calm that comes when you finally stop trying to outsmart the market and start trying to understand it. That's when you realize it's not about prediction, it's about recognition. You don't need to predict the reversal, you only need to recognize it when it begins. And if you can do that early, you won't just survive, you'll thrive. But make no mistake, the market won't reward impatience. You'll be tempted to call every pullback a reversal, every bounce a bottom. That's how traders get chewed up. You must wait for confirmation, but not so long that the move has already passed. It's a fine balance, the kind you can't teach, only develop through experience. Have you got the patience for that kind of learning? Most don't. That's why most lose. So when you open your charts tonight, I want you to forget the noise. Don't look for the next big thing to buy. Look instead for the subtle signs of change. Where is momentum shifting? Where is conviction fading? Where is the crowd still drunk on certainty while the tape quietly disagrees? That's where reversals are born, and that's where the professional prepares. Price hesitation signals the first whisper of reversal. Most traders never hear that whisper because they're too busy staring at indicators, waiting for a line to cross another line or for a candle to light up green. But the market doesn't speak in colors or lines. It speaks in behavior, in the pauses, in the hesitations, in the moments when the price starts acting differently than it used to. That's where the truth hides. When a market has been trending strongly, you'll see it move with confidence. The swings are smooth, reactions are controlled, and every pullback feels like a coiled spring ready to push higher again. But when that rhythm starts to change, when the once clean moves begin to stumble, that's the market whispering to you that something's shifting beneath the surface. I've always said that a trader must learn to listen to the market as if it were a living thing, because it is. It breathes, it hesitates, it reacts to pressure, and it grows tired. Price hesitation is the market's sigh. When a stock that's been climbing relentlessly suddenly starts pausing after every small rally, that's not random. It's a sign that buyers are starting to second guess themselves. They're asking, is this still worth chasing? And that hesitation spreads like a quiet rumor through the crowd. The public never notices it early because the chart still looks bullish at first glance. But if you look closely, you'll see a subtle change in personality. Candles that used to close strong now fade before the bell. Intraday rallies that once exploded now stall midway. Do you notice that kind of behavior when you trade, or do you only see the trend you want to see? In my own trading years, I learned that reversals never arrive with a drum roll. They sneak in through hesitation. It starts small. A stock stops making new highs even as the general market keeps rising. You might see the price stall near the same level for several sessions, as if invisible hands are pressing down on it. That's your first clue that supply is beginning to overtake demand. The tape might still look healthy to the untrained eye, but the pulse has changed. I remember watching leading stocks behave that way before major tops. The public was still excited, buying every minor dip, but I could see the tape struggling. The energy was different. When a trend is strong, buyers don't hesitate. They compete. They chase price higher. They swallow offers, and volume swells easily. But once hesitation creeps in, the balance of emotion shifts. The traders who used to fear missing out now begin to fear losing profits. That tiny change in psychology shows up in the chart before it shows up in the news. The range tightens, the pace slows, and the conviction fades. It's like watching a dancer who suddenly loses rhythm, still graceful, still moving, but no longer in perfect time with the music. Most people don't see hesitation because they're focused on direction, not behavior. But a trader's real job isn't to predict where price will go. It's to recognize when price is acting differently than it should. If an uptrend has been steady for weeks, making higher highs and higher lows, and suddenly that pattern stalls, you should be paying attention. You might see 2 or 3 attempts to push higher that fail quickly. You might notice that each rally now ends sooner than the last. These aren't coincidences. They're signs of distribution. The professionals are unloading their positions quietly, while the public still believes everything's fine. Have you ever been in a stock that looked strong right before it started falling apart? That's because you ignored the hesitation. The first hesitation in price is like the first crack in ice. It might look harmless, but it tells you that the structure beneath is weakening. And just like ice, once the pressure mounts, that small crack spreads fast. The trader who waits for confirmation from the crowd will always be too late. The crowd doesn't see cracks. It only sees reflections. They'll tell themselves, it's just a pause, or it's consolidating before another move. And sometimes that's true, but often it's not. Your job is to tell the difference. So how do you recognize true hesitation and not just normal fluctuation? It comes down to context. If price hesitates after a long, extended run, that's meaningful. The market doesn't move in one direction forever. Every trend ages, and hesitation is how it grows old. Look at how the candles form. Are the rallies shorter? Are the pullbacks deeper? Are the closes weaker? That's the market showing fatigue. In an uptrend, you'll see the stock start to close near the middle of its daily range instead of at the highs. The same thing happens in reverse for downtrends. Price stops collapsing and begins closing higher off the lows. Those are not random quirks, they're signals of a shift in power. In my early days, I didn't understand that. I used to think that as long as price was above my moving average, I was safe. But markets don't turn because of lines. They turn because people change their minds. And people change their minds slowly at first. The big traders, the ones who move real money, start to sense when a move has run its course. They stop pressing their bets. They take profits quietly. They sell into strength. That's what creates hesitation. The invisible tug of war between fading demand and growing supply. If you were to watch the tape carefully during that time, you'd notice that big orders start appearing on the sell side more often. The speed of trades changes. The bursts of buying that once pushed price effortlessly now meet resistance. It's subtle, but once you've seen it a few times, you'll never forget the feeling. It's like the air in the room changes. Something that used to flow easily now feels heavy. Do you ever feel that tension when watching a chart? That sense that price wants to go up, but something keeps holding it back? That's hesitation. Hesitation also shows up in how traders react to news. When a market is healthy, good news drives it higher, bad news barely dents it. But near a top, even good news fails to push price meaningfully higher. The enthusiasm is gone, though the public doesn't realize it yet. That's when you start seeing headlines like, "Market shrugs, off great earnings." The market isn't shrugging. It's signaling that the trend is weakening. Professionals recognize that behavior and begin to prepare. The public, on the other hand, thinks it's just a pause before another rally. That's the fatal difference. If you want to develop the skill of recognizing hesitation, you must learn to detach yourself emotionally from your positions. The moment you're too invested in being right, you'll stop seeing clearly. You'll interpret every pause as a sit up for continuation. But price doesn't owe you continuation. It owes you nothing. All it does is show you how other traders are feeling. And when the collective feeling shifts from confidence to doubt, the doubt shows up first in hesitation. It's important to remember that hesitation doesn't always lead immediately to a full reversal. Sometimes it turns into a sideways range before breaking out again. That's why patience is essential. You're not reacting to the first pause, you're studying it. You're observing whether the market regains its stride or continues to stumble. If the hesitation deepens, if rallies keep failing sooner, if lower highs begin to appear, that's your cue that the trend is decaying. This kind of reading takes practice, and it can't be taught from a book alone. You have to watch hundreds of charts over months and years, and pay attention to how hesitation looks in real time. Write down what you see. Note the signs. Smaller candles, shorter pushes, fading volume, weaker closes. Over time, you'll start recognizing the pattern instinctively. The best traders don't predict reversals. They recognize hesitation before others do. You'll also notice that hesitation feels uncomfortable. It tempts you to ignore it because it challenges your conviction. The trade that once made you feel safe now feels uncertain. You start looking for reasons to explain it away. It's just taking a breather. You tell yourself, but the market doesn't care about your comfort. It only cares about balance. And when that balance shifts, it doesn't announce it with fireworks. It starts with hesitation. Think about how many traders lose fortunes, not because they missed an entry, but because they refused to see that hesitation meant the move was ending. They watch their profits evaporate because they mistake fatigue for strength. I've seen it too many times. A man makes a killing on the way up, then loses it all because he couldn't bear to admit the tide was turning. Price hesitation was right there on the chart, plain as day, but he was too blinded by his own success to see it. That's why I always tell traders, don't fall in love with your trades. Fall in love with reading the market. Because the moment you care more about being right than about what the market is telling you, hesitation will sneak up on you like a thief. And by the time you recognize it, the reversal will already be underway. Price hesitation is your first and most reliable warning. It's subtle, quiet, and easily ignored. But it's also the earliest sign that something's changing in the market's heartbeat. Learn to feel that change, and you'll be ahead of most traders who only react after the storm hits. The market always whispers before it roars. The question is, are you listening? Heavy volume on down days confirms smart money distribution. That's a phrase that every serious trader should engrave into their thinking, because it's one of the simplest truths about market behavior and one of the easiest to overlook. You see, markets aren't driven by opinions or predictions. They're driven by transactions, by who's buying, who's selling, and how much of it they're doing. And nothing reveals that dynamic more honestly than volume. Price tells you where the market is going. Volume tells you who is behind the move. When price begins to fall and volume swells, it isn't random noise. It's a message from the professionals. It's the quiet confession that those who know the most, those who hold the largest positions, are unloading while the public is still dreaming of new highs. Most traders get fooled by the surface of the market. They see a dip and think it's a buying opportunity, because the news still sounds optimistic or because the chart looks fine. But the tape tells a different story. When you see heavy selling volume on a down day, you're not just looking at red bars, you're watching smart money transfer risk to the crowd. The professionals don't ring bells when they sell. They distribute their stock carefully, quietly, and consistently into the hands of those who still believe the trend will continue. Have you ever wondered why a stock starts dropping hard on what seems like no bad news? That's because the insiders and the sharp operators aren't waiting for headlines. They're acting on behavior. When a trend is strong and healthy, down days come with light volume. It's natural profit, taking, nothing alarming. The dips get bought, volume picks up again on rallies, and the overall tone stays constructive. But when the character changes, when down days suddenly come with surges in volume while rallies grow quieter, that's your first clue that something's shifting. The crowd often mistakes this as volatility. It's not volatility, it's distribution. The big operators are unloading. They can't just dump millions of shares in one go without crashing the price, so they sell strategically, on strength when they can and on weakness when they must. The tape records their footprints for anyone patient enough to read them. I remember watching the market during one of those roaring bull years. Everything going up, optimism in full bloom. The leading stocks were making headlines every week, and yet, when I studied the tape, I noticed something subtle. The advances were getting sluggish, but more importantly, the sell-offs were coming heavier. Volume was surging on the down days. You could feel it in the tape. The pressure was building. That was smart money stepping aside. The public, drunk on excitement, thought every dip was a bargain. They were buying what the professionals were selling. A few months later, those same bargains were down 50%. That's how the game works. Volume is the market's polygraph. It never lies, though it often hides in plain sight. When you see a stock dropping on big volume, you must ask yourself who's in a hurry to sell. Big players don't sell for no reason. They sell because they see something changing. Maybe valuation, maybe liquidity, maybe sentiment. The reasons don't matter. What matters is the action. If you pay attention, you'll see that before every major top, the pattern is always the same: big down days on heavy volume, small up days on light volume. It's the rhythm of distribution. The professionals are transferring shares from strong to weak hands. Now, I want you to picture the psychology behind this. During a bull move, the public becomes conditioned to buy every dip. It's worked before, so they expect it to work again. They see a down day and think, great, a discount. Meanwhile, the professionals see that same down day as an opportunity to sell more into the rebound that follows. They understand that distribution isn't an event, it's a process. It takes time. They use the crowd's optimism against them. That's why you often see markets make new highs even while the smart money is selling. They need those new highs to attract more buyers so they can continue distributing without crashing the price. Do you ever wonder why markets often top on great news? It's because the big players use good news to sell into strength. If you study charts long enough, you'll start noticing that the heaviest volume days often appear right before or right after a major turning point. It's not coincidence. It's the final phase of distribution. Think of it like a crowded theater. Everything looks fine until one person heads for the exit. Then 2, then 10, and suddenly the rush begins. The first to move get out easily. The last ones get crushed in the stampede. The same happens in markets. When you see price drop sharply on heavy volume, it's the big players heading for the exit. They're not panicking. They're efficient. They've already been unloading for weeks. That final burst of volume is simply the door closing. Volume also tells you about conviction. When a stock drops on low volume, it might just be a lack of interest. But when it drops on heavy volume, that's commitment. Somebody's serious about getting out. And when that happens repeatedly, you know you're witnessing a transfer of ownership. Professionals understand this intimately. They don't need indicators to tell them. They feel it in the flow. The tape becomes heavy, the bids vanish faster, the bounces get sold quicker. That's distribution at work. Many traders make the mistake of chasing strength without checking what's happening underneath. They see price rising and assume everything's fine, but if you look at the volume pattern and notice that each rally comes with declining participation, while each decline comes with surging activity, that's the market whispering the truth. It's like a man who smiles while sweating. He might look calm, but the signs tell a different story. The great irony is that the public always gets most excited right when the professionals are most eager to sell. During the final phase of a bull move, news headlines are glowing, analysts are raising targets, and everyone is convinced the trend will never end. That's when you start seeing those heavy down days appear. The first cracks in the wall. Most ignore them because optimism blinds them. But the professional trader knows that heavy volume on a down day is never random. It's evidence. It's activity that can't be faked. I used to sit by the ticker and watch how the tape behaved after a long advance. You could tell when distribution began. The selling wasn't obvious, but it was persistent. Each rally met quiet resistance, and the volume during declines swelled noticeably. It wasn't panic, it was professional liquidation. The market was changing hands, And when the final stage came, when the last buyers stepped in, that's when the big operators finished selling. Then came the real break, and the crowd was left holding the bag. You have to understand something. Markets are like living organisms. They exhale before they collapse. Heavy volume on down days is the exhale, the release of pressure that's been building for weeks or months. It's the sound of professionals emptying their lungs while the amateurs are still inhaling. You can't stop it, but you can recognize it. This is why a trader who studies volume alongside price has a tremendous advantage. Price alone can fool you. A market can appear strong while volume quietly tells you otherwise. But when the two align, when price weakens and volume surges, that's confirmation. That's not fear, that's informed selling. And you must never ignore informed selling. Have you ever looked back at a chart and realized the top was obvious in hindsight? Those big red, volume days were probably there all along. The signs were visible, you just didn't listen. Another thing most traders forget is that smart money doesn't always sell aggressively at the top. Sometimes they sell gradually during strength in a way that barely moves price.